Hello, this is Greg Harrelson here with Center 21, the Harrelson Group in Myrtle Beach, South Carolina. And I just wanted to shoot a video it's really on a question that we are getting so often right now. And it has to do with financing, mortgages and interest rates. You know, as you know, we work with a lot of buyers that are coming from out of the area and they're looking to buy primary residences, second homes, investment properties. And they're asking a question that I think is a great question. And the question is, how does one's credit score actually affect the interest rate that they're going to get on their loan? So I'm not a mortgage professional, so what I've done is I brought in Adam. And Adam, please, could you tell us how to pronounce your last name?
Sure. The last name is Paskanik, so rhymes with mechanic, Paskanik.
Okay, good. And you know, I know his last name, I know how to spell his last name, but I don't know how to pronounce it. So anyways, Adam, why don't you help the audience out, because we're getting this all the time. You're a professional, South Atlantic Bank, I think.
Yes.
And tell us, I mean, how does credit scores impact one's interest rates when getting a loan?
It's the biggest factor you can have in an interest rate versus a person with, let's say, a 620 or a 740. Okay. What it is Fannie Mae dictates a loan level pricing adjustment based on your credit score. So the lower your score is, the more risk there is in the loan for the bank, Fannie, Freddie, anybody. It's a riskier loan because your credit's lower. So to offset that, you have to raise the interest rate. So we've seen right now in our market, it's currently, you can have a 0.5% spread on your interest rate solely on your credit score. And that's a big difference on a 30-year note. So, you know, just think of a 30-year note and how long and how much more interest you would pay for 0.5% based on a couple maybe little things you could do to fix your credit or get a higher score. Huge difference in the long run.
Well, good. So interest rates are tied to risk, which
yes,
is one of the things that I'm hearing, which I think all of us watching this video could probably understand. I mean, that just makes sense. So there are things like, you know, credit repair and things like that that you can do. And I won't go into it on this video, but
sure.
Do you help people with things like that? At least kind of coach them on some things or some tips that they can do to improve their credit scores?
Absolutely. Everyone's, you know, credit report is different, of course, but there's a lot of general things. I can look at a report immediately and say, oh, you need to do this, this, and this, and that could be in a 30-day window, a 60, 70-point increase. A lot of times folks didn't even know they could do certain things. So there's always something you can do to get a score up. I mean, it's low for a reason, so there's things you can fix.
Okay. Well, I definitely want you to, I'm going to repeat this one more time because I think this is really critical, and it's definitely something I want everyone watching this video to understand, that don't be discouraged. If your credit score is a little bit lower than than you want it to be, don't be discouraged. Talk to a professional, a mortgage professional. They might be, as he said, might be able to look at your credit report and make a couple little suggestions that within the next 30 or 60 days, you could raise your credit score anywhere from 60 to 70 points, which that could probably make the difference in the interest rate.
Absolutely, absolutely. Yeah. And that could be a difference between approval and denial.
There you go. So if there's anything we can do for you, I'm Greg Harrelson with Center 21, and we've got Adam
Paskanik
with South Atlantic Bank. Let us know how we can help you.